Hi, Dale Torito here, TFS Advisors. Today we're going to talk about investing. Investing is hard, but speculating is harder. One of my coaches, Amy Crow, and yes, I have coaches too, was talking with me about cognitive distortions. Now, my apologies to all clinicians out there, as I am not one, but I have studied investor behavior for some time now. So, taken from her materials, one distortion that I see regularly is magnification, also called catastrophizing, if I said it right, or minimization. This is also known as the binocular trick. For its stealthy skewing of your perspective, this distortion involves exaggerating or minimizing the meaning, importance, or likelihood of things. Now, we've been fed the Armageddon scenario so much that it's hard to think otherwise. This comes from all sides because fear gets your attention and makes you want to act. It assumes that the sky is falling all the time, causing us to be on alert constantly. It is difficult to ignore unless you turn off the source of the prognostication. I look at it this way. When I'm outdoors, especially in the mountains, I'm not thinking of the bit of news predicting the end of our civilization that is played over and over again for weeks. My brain has a chance to recharge, and I worry more about happening upon a bear than about bear markets. Now, being an investor is hard, but being a speculator is harder. Speculation assumes you make the right moves at the right time all the time. Investing is hard because it requires patience, especially during scary times. As cited in a U.S. News 2019 article, research shows that despite robust investment market returns, investors rarely match stock and bond performance. And they cited a Dalbar study that showed that between 1987 and 2016, the average investor earns 2.6% annually despite a 10.2% gain in the U.S. stocks, a 6.3% uptick in government bonds, and a 5.4% return in international equities. We as investors get in our own way. There was much evidence that the primary driver of investor returns is their own behavior. Now, I recently read the book, The Psychology of Money by Morgan Housel. Chapter 6 is titled, Tails You Win, and the subtitle reads, You can be wrong half of the time and still make a fortune. So let me read a story from the book. Consider what would happen if you saved $1 every month from 1900 to 2019. You could invest that $1 into U.S. stock market every month, rain or shine. It doesn't matter if economists are screaming about a looming recession or a new bear market. You just keep investing. Let's call an investor who does this Sue. But maybe investing during a recession is too scary. So perhaps you invest your dollar when the economy's not in a recession. You sell everything when it's in a recession, and you save monthly dollars in cash and invest everything back into the stock market when the recession ends. We'll call this investor Jim. Or perhaps it takes a few months for a recession to scare you out, and then it takes a while to regain confidence before you get back into the market. You invest $1 in stocks when there's no recession, you sell 6 months after the recession begins, and invest back 6 months after the recession ends. We'll call you Tom. So how much money would these three investors end up with over time? Sue ends up with $435,000 in change, Jim has $257,000, and Tom has $234,000 in change, but Sue wins by a mile. There were 1,428 months between 1900 and 2019, and just over 300 of them were during a recession. So, by keeping her cool during just the 22% of the time the economy was in or near a recession, Sue ends up with almost 3/4 more money than Jim or Tom. I did not do the math to verify the values, so I thank you, Morgan, for the story. In another area of the book, it talks about making your finances unbreakable. This basically means to position yourself to withstand any recession or shock to the system. Now, we do this in our planning with clients and call the process buffers, but I think I might start calling them shock absorbers. Think about your car. Imagine it without any shock absorbers of any kind. Every bump, dip, pothole, ridge, and curve would upset the ride of the car, probably making it unsafe to ride in. You would feel everything, and if the right chain of events happened, they could magnify each other. Then you add shock absorbers, and the ride smooths out. You still feel the bumps, dips, potholes, ridges, and leaning that occurs in the corners, but the ride is safer. If the shock absorbers wear out, you simply replace them. Our work with clients is a lot like the shock absorbers in your car. Sure, we help with investments, and our job is even more about helping clients envision the future and what they want for their families. But we also need to help them see the future while providing strategies that act as the shock absorbers in life's events. Adding buffers to the planning allows them to focus on what is important to them, having confidence that they are set up to be as unbreakable as possible. So until next time, this is Dale Torito, and we are TFS Advisors in Edmonds, Washington.